All right. Good morning, everyone. Happy Monday. We'll go ahead and wait just a couple minutes to go live on all the different platforms. So hang tight with us. Go ahead and drop a comment in there if you're just getting on. Good morning. Good morning. There we go. We're up and getting it going on a Monday. Definitely interested to see what the rates look like today. Definitely some interesting things going on. So it's going to be very interesting.
Yes, quite the news. Quite the news.
Absolutely.
I think some of our new rate sheets might take a little while today. I think a lot of people are going to be sitting on the sidelines for a minute, so we should do the show later in the afternoon today to really see what it ends up. But
yeah, I'm sure some people will be pretty updated.
Oh yeah, we'll have rates, but I think the big action will be in the afternoon. Some interday changes.
But welcome everyone who just jumped on. We're just waiting a few minutes here to make sure we get to go live on all the different platforms and to make sure everybody gets a minute to just tune in before we get started. But good morning, everyone checking in. This beautiful Monday morning, ready to get some loans done this week. All right. It looks like we are live everywhere, so we can go ahead and get this started then. So, welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. What we do every morning is go through the live rates, the live mortgage rates every morning at 11 a.m. Eastern time. And today's going to be especially interesting because the rates are definitely changing with all the things going on in the news and in the market right now. So, after we check out the rates, we will go into a deep dive on a topic like we do every day. And today's deep dive is going to be DSCR Loans. We're going to take it back to the basics here of our favorite program, the DSCR program, Debt Service Coverage Ratio, which allows an investor to purchase a property with no income verification, no employment verification, a very easy loan to get as an investor, and a very powerful tool for us to use as loan officers. So we're going to have Jose do a deep dive on that a little bit later. But right now, super excited for Nick to pull up the rates. So let's pull up that rate tool and see what the rates look like this morning.
All right. Thank you, sir. Yes, should be interesting. I do recommend everybody check out later in the afternoon once we have some settlement from all of the activity this weekend. But let me go ahead and change my screen and get into it. All right. So this is our pricing tool. This is for our team of mortgage professionals. If you'd like a full loan estimate, please get with one of our loan officers. We have over 350 loan officers. We are licensed in 22 states for primary and second homes, and we can do our DSCR loans, our business purpose rental loans, in pretty much all states, which is going to be our deep dive topic for today. But this is our pricing tool. It's just going to give our indication of the rates today. It is March 13th, 2023, just after 11 a.m. Eastern. So most of our standard programs have our rates issued for today. Again, a lot of activity after a couple banks got shut down this week and this weekend. So a lot of volatility going on. The 10-year is down, which is usually a good indication for the live rates coming down a little bit. So let's check out some basic scenarios and see what the activity is for today. So for all of our loans today, we're going to set up a basic scenario. Nice, easy 400,000 loan amount here. I set the LTV, the loan to value, to 80. That means an 80% loan, 20% down payment. We're going to tell the computer to search for the best rate at a 99 price. What that means is one discount point in cost. So most of our customers are asking to buy down the rate a little bit since the rates are typically up in this environment. So we'll look for the best rate for one discount point in cost. We're going to go through a couple examples for our primary homes. We're going to do conforming conventional. Then we're going to check out our FHA rates. And then we'll go into our expanded guidelines, aka non-QM. That's where we specialize at the Mortgage Calculator. We have over 4,500 loan programs under expanded guidelines, which allow us to use alternative income. We also can quote VA and USDA, but we don't do that live on the show. If you are an eligible veteran, that is great. We would love to quote you. But since not everybody is an eligible vet, please get with our team if you'd like a quote. We'd be happy to do that. And same with USDA. That's only for properties that are in eligible USDA eligible areas, usually rural areas. So if you're looking in those types of areas, let us know and we can quote it very quickly. But since it doesn't apply to everyone, we won't do it today. So first example we'll set as conforming conventional. We're going to do a purchase, 30-year fixed, pretty standard loan, primary home for these first examples, single family, one unit, nice and simple, state of Florida, Miami-Dade, that's where our office is. And for all of our examples, we use an estimated FICO of 760 today and an estimated debt to income of 40 today. So let's check out what our rates are this morning. So yes, we love to see some downward activity here. So last week we were in the 7s. Now we're here at 6.5. It looks like the best combo, 6.5 rate for one discount point in cost. So we love to see as the rates go down, but we love to do the show and keep it real with you guys and show exactly what they're doing every day. So today is a good day for everybody. Again, there'll probably be some more changes interday. So please get with our team if you'd like to quote those and get with one of our loan officers so that they can monitor as we go through the day and pull up these pricing scenarios as the different economic news comes out. So now if a customer for any reason doesn't qualify for a conventional conforming loan, the next option we typically do, we'll set up the same scenario, is we'll look at an FHA option. So we'll keep everything else the same as we did before, and we'll quickly compare our FHA to our conventional rates. So it looks like FHA has gone down a little bit as well. Not as drastically probably from last week, but always good to see downward motion, right? So best combo the computer found here. Let me scroll down a little bit. Yeah, it looks like everybody, all these programs here at 6% rate for 0.75 in discount point cost. And remember to always compare APR. So the APR on this FHA, 6.593. You saw the conventional ones a second ago were around 6.5 as well. So right now, actually, conventional went down and FHA didn't go down as much. So right now, they're about even. Remember, yesterday, FHA was way better than conventional. So we love to do this show so you guys can compare side by side, apples to apples, and compare those APR. Also, keep in mind, FHA did last month release some changes, and it's going to be live at the end of this week for all loans for a reduced MI figure. So that's great news for the FHA programs. Please get with our team to quote those. Now, for our last example for primary homes, if a customer doesn't qualify for some reason for conforming or FHA, we typically, or a lot of other lenders do not have other options, but we typically will have 4,000 plus other options under our expanded guidelines. So if we set up the same exact scenario, keeping everything else the same, we have one new option that pops up under non-QM, and that's where we can choose our income type. So we could do full doc, but that's what we have to do for conforming conventional loans, 2-year tax returns, all that. So the point of switching to a expanded guidelines non-QM program is typically to do alternative income. So we have 1-year alt doc, 2-year alt doc. We can do an asset related loan. We did a couple episodes on that before. Check those out. We can use business bank statements 12 and 24. DSCR we'll go over in a minute here for our investment properties. And our most popular program by far for non-QM for someone purchasing a primary home that can't qualify with 2 years tax returns is going to be our personal bank statement 12 months program. And that's going to be for our self-employed borrowers. So typically a self-employed borrower, when they file their tax returns, they have various write-offs. And a lot of times they can't qualify or at all, or either can't qualify for enough of the home that they want to purchase. So instead, we will use 12 months of bank statements here to determine their debt to income ratio based off their actual cash in the bank, their actual cash situation, which typically affords them a much higher qualification and allows them to qualify and purchase the home that they're looking for. So this is our most popular program under non-QM. So let's check out our rates this morning. So it looks like a little bit of downward movement here as well. Non-QM doesn't move as drastically, but some great news always. 7.375 rate. Obviously, it's going to be a little bit higher than our conforming and our FHA programs. These are alternative documentation, but still great options for our borrowers who would not otherwise qualify. So 7.375 rate, 0.75 discount points and costs, and remember to always compare the APR 7.414 so you can compare apples to apples. So again, these are programs that allow us to use different income documentation to allow our borrowers who would not otherwise qualify, or for them to qualify for the home that they actually want to purchase. And we could typically get them a much higher debt to income figure using these programs. Now, before we pass it over to Jose for a deep dive, I'm going to go into the quick pricing here for our couple basic investment property scenarios, but Jose is going to actually go into a real detailed example here in a second. So for our last example of the live rates, we're going to do some investment property examples as we do every morning. And we're going to compare our two options. So we have our conventional programs or we have our non-QM programs. Remember, FHA via USDA are not eligible for investment properties. So we're just going to compare our two channels here. We'll start with our conforming. Everything else will stay the same. And we'll check out our investment property rates here. As I say every morning, there has been some adjustments there by the GSEs, the entities that offer these loans for conventional loans, and they have added price adjustments for investment properties. So the computer's unable to find a rate with one discount point in cost. But the best combo the computer found here with the best APRs, obviously what we're looking for, is a 7.125 rate for 3.375 discount point in cost for a final APR of 7.38. If you scroll down here, even if we go up in rate a little bit, 7.49, our discount points are still pretty high, 2.625 discount points. So many times our investors buying investment properties would like other options. And that's where we love to provide our non-QM and in particular our DSCR options, which Jose is going to go into in detail here in a second. So for our last example, let's compare those conventional investment properties to the same scenario under expanded guidelines non-QM. And the first option we get here now is our income verification. And we're going to choose our most popular one by far, our DSCR, debt service coverage ratio, as Kyle mentioned earlier. And that's because it does not require income from the borrower or employment from the borrower. We're simply going to use the estimated rental income from the property we're purchasing in order to determine if that rent can cover the PITIA of the mortgage payment, right? The housing expense of that property. If it can cover over the cost, that's a ratio over 1. We have tons of options for those. And we even have some DSCR options for under 1 ratio, aka a property that doesn't quite cash flow enough to pay the mortgage payment, but we still have some options for there, a little bit more spendy. Now, the other option we have to select for our non-QM investment properties is going to be our prepayment penalty. It's pretty standard. We can choose 0, but that's going to limit the amount of loan programs we have. So we're always going to choose 3 years for our pricing scenario here on the show. So we have the most options. That's typically standard. We could also choose 5 years if we wanted to save a little bit of money. That'll be a lower cost there. So let's set it at 3 years, for example, and let's check out our DSCR rates today. And again, this is going to be a little bit higher rates than conventional, but great options because you see we are saving our investors money out of pocket. So 8.25 rate. So money investors, as long as the property cash flows on a higher rate, they want to save discount points. So 8.25 rate for 0.85 in discount points and a final APR of 8.292. So a great option for our investors that want to use these programs and save money out of pocket to invest in other rental properties and other projects. So there's a ton of different options here you'll see with different DSCR values. That's why Jose is going to go into a deep dive here in a second and explain all the different flavors of this program. Some of these may allow things like short-term rental income to use for our ARDNA analysis, which may end up in one of these higher rate options. So a lot of great options we have, just a ton of different programs and flavors here with different prepayment penalties and stuff. So please get with our team. We'd love to find the best options that fit your scenario. But without further ado, let me get into our deep dive and take this topic further here and have Jose explain a couple different flavors for, I'm guessing, a specific scenario. So let me go ahead and switch my screen and then I'll pass it over to you, buddy. 1 second. All right. So before Jose gets started, just want to introduce the topic. Again, we're talking about our DSCR loans, our debt service coverage ratio loans. As Kyle mentioned and I mentioned earlier, these do not require income or employment from the borrower. We're simply going to analyze the estimated rental income from the property and compare that to the mortgage payment, the PITIA. So Jose is going to show you a detailed analysis of that here. And Jose Gonzalez is our sales manager with 27 years, is a loan officer as well as a realtor. So a lot of great experience both in the financing and obviously going through the income and doing all the great stuff that the realtor hat affords. So why don't you go ahead and take it away there, Jose?
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Jose Gonzalez here, sales manager of the Mortgage Calculator. DSCR is our flagship product. We fully embrace DSCR at the onset of the establishment of our company. Obviously, because we're looking for all of the outside the box solutions that everybody isn't. So DSCR does lend itself to a lot of uses. So what I'm going to do here is get back to the basics, so to speak, because there's nothing really basic about DSCR. But for us, this would be really going back to basics and just talking about, what is DSCR and, how can it be used. And then in some future episodes soon coming, we will go into additional, more detailed examples of using DSCR loans. So, in our first example here, I'm presenting the highest LTV DSCR option, right? For this DSCR option, there is a minimum debt service coverage ratio of 1.25. So, what exactly does that mean? Okay, so debt service coverage ratio is the percentage that the rental income of the property is covering the housing expense of the property. So, housing expense being principal, interest, taxes, and insurance, and if applicable, association fee if it is a HOA type property. And then your rental income is the rental income. However, there are different ways that rental income can be determined, which is what Nick was alluding to, where some of the options that we have could have a little bit higher cost because they have additional functions that are possible, let's say, like, for example, using projected short term rental income from a property using the AirDNA database, right? So that's pretty way out there from your traditional using a 1007, which is a market rent schedule prepared by the appraiser as an additional report to the appraisal, right? So in some cases, the investor, in this case, the end buyer of the loan, may say we only accept a long-term rent 1007. In other cases, they may say we only accept the 1007 or the lease or the short-term rental reports, whichever is lower. In other cases, they may say we'll take any of the three, right? And in some cases, they'll say we'll take any of the three plus we may also accept AirDNA for purchases only. So there's a lot of different variables that come into play into how exactly do you quantify the rental income. And that's the beauty of it. That's where all of the different solutions that we can provide come into play. We're not just straight, cookie cutter 1007 all or nothing. We do have options. That's why we're so different than going to your traditional bank, which has no options other than agency loans, basically, and maybe every now and then a line of credit. So, with that amount of context being given to everyone here, then I'll go into my example so you can understand a little bit how we can differentiate, right? So, in our first example, and in all these examples, we're using a 3-year prepay. These are investor only loans where prepays are allowed, on a primary, There's never a prepay, but DSCRs are investment only. And, we like to put in a 3-year prepay for pricing purposes. So our first example, 15% down, does require 1.25 minimum DSCR, meaning that the rent generated by the property has to cover at least 125% of the housing expense. So if you can do that, plus meet the other parameters of this loan, then you got a deal. 85% loan to value, 15% down, purchase on a DSCR. Amazing option. Not always possible because of the DSCR. So next example. Now here though, let me go over quickly on the rates here. 9.75 is the lowest cost option, and 9.25 is the lowest option at which you can buy down the rate. So our next example would be the more traditional 20% down DSCR purchase that only requires a 1.0 or higher DSCR, debt service coverage ratio. So you will see here the rates get much better because there are more options available. There are more investors offering this option. So here we're looking at 8.5%, actually offering a little bit of a lender credit. And you can buy it down all the way to 7.625%. So I'll just click on over to the other option where you can see it's 9.75 down to 9.25. And here we're looking at 8.5 down to 7.625. So substantially better. I mean, the 15% down option is, really probably only an option for like the best properties where there's no buy down and the customer just wants that higher rate, because if they're going to start buying down and all that stuff, they're really going to get really close to doing this option with no buy down and a lender credit at 8.5%. May be a better option for your customer. Just food for thought there, because of the buy down really affects your cash outlay. So now we have our 25% down option. And now, obviously, your investors typically want the lowest down payment, but in some cases, they're pre planned a certain financial plan, and 25% down is what they want to do. Maybe they want lower rates, they just want to owe less. So that's fine. The rates do get better with 25% down, because, I mean, there are other options that I'm going to show you now in a minute, where if you have a property that's not fully cash flowing at 100% or higher, we do have our less than 1.0 options. Rate are substantially higher. So that would be the usual option why people would go 75% loan to value, is really because the property doesn't cash flow and they need one of those options, which I'm going to show you right here. So, but in this 25% down option, you will note the rate's substantially better. 8.125 is the lowest cost option, and you can buy it down to 7.325, which if we click on over to the 20% down option, you'll see that it is a little bit better pricing. Over here, 8.125 had 58.50 cost. Over here, 8.125 has 19.69 cost. So now I mentioned to you the option where the property doesn't fully cash flow. So we have our 0.75 to 0.99 option, meaning that the rental income is covering anywhere from 75% to 99% of the housing expense, but not at 100%, but we can still do that. You're looking at 10.125 as the lowest cost option, 9.25 as the lowest rate option. And again, you're going to use this, where it's not fully covering. This could be, for example, short-term rental properties where they're being sold at little bit higher price because they're taking into consideration the short-term rental income of that property. And if for whatever reason you may not be able to capture the short term rental income, which is usually how we like to structure those loans, because we do have options for short term rental income. But for that odd scenario where we cannot capture the short term rental income, we do have the 0.75 to 0.99 DSCR option. So this is a very good option with a 75% max loan to value on a purchase. So what happens if you don't even make it to 0.75 on the debt service coverage ratio? We do have an option for that. It would require a little bit more down payment, 30% down, but this is a very good option for your property that does not even cash flow at 75% of the housing expense. So less than 75%, believe it or not, I know this is a mind blower, but we can close that loan. As long as they got the credit requirements, you're not going to be able to get this option with a 660 or 680 credit, mind you. So, keep in mind that higher risk will require a higher credit score, but nevertheless, here you can still offer 10.75 as the lowest cost option and 8.875 as the lowest rate option. So very good rate still at a 70%. You can still get down into the eights for this option on a property that does not cash flow. Not very many options for this program, but they are out there. Typical use again for this would be that trophy property that you're buying. You see the value, it's worth it. You absolutely want it. Well, if you got 20% down, we can get it for you. So, very good options here. We have 5 options for a DSCR purchase, all with their specific situations where they can be applied to. So please reach out with any of these scenarios, and we'll be more than happy to structure any of your DSCR loans for you. There should not be any loan that we cannot do as long as the credit is there and as long as the customer's expectations are in line with what is possible with their data.
That's the beauty of the DSCR. It can't be denied, right? Once we have the data, there's always going to be an option. Might not be as low a down payment as you want, but there's always an option. We love it.
Yeah, absolutely. Okay, thank you, Jose. So let's go ahead and wrap it up here then. As you can see, we have plenty of programs, and we have over 350 loan officers all around the country, licensed in 22 states to do primary homes, and these DSCR loans we could do in most states for the DSCR business purpose loans. So if you would like a quote for your own scenario, an actual quote with the live rates, you can contact us. You can go to themortgagecalculator.com, or you can email us at info@themortgagecalculator.com. We will pair you up with one of our loan officers that can walk you through this process. Now, as you can see with all these programs, our loan officers are not just trained in conventional, primary residences. We are also trained to do all these different programs, all these non-QM programs, from everything to the bank statement loans to these amazing DSCR loans and fix and flip and ground up construction and land. And, we have everything under the sun here at the Mortgage Calculator. So visit us at themortgagecalculator.com or send us an email, info@themortgagecalculator.com, so we can pair you up with one of our loan officers. We do this show every single weekday, 11 a.m. Eastern time. It's going to be interesting to pull it up tomorrow as well and see what's happening in the meantime as well with the rates. So tune in tomorrow, 11 a.m. Eastern time, and we'll see what the rates look like. Thank you, everybody, for tuning in. Have a great Monday.
Thanks, everybody.
Thank you, everybody.